Imagine a commercial jet engine, at cruising altitude.
Right, way up there.
Yeah, you are 30,000 feet in the air. The air outside is, 50 degrees below zero?
At least. It's freezing.
But inside the combustion chamber of that engine, the temperature is pushing 3,000 degrees Fahrenheit.
Which is just an insane extreme.
Totally. And the turbine blades spinning to generate that thrust are rotating at tens of thousands of revolutions per minute. They're experiencing centrifugal forces that would, just rip normal steel apart like wet paper.
Oh, absolutely. Standard metals wouldn't stand a chance.
And here is the truly wild part. The temperature inside that engine is actually several hundred degrees hotter than the melting point of the metals used to build it.
Right, which sounds physically impossible when you hear it. I mean, you have a metal component operating in an environment hotter than its own melting point.
It's like putting ice in an oven and expecting it not to melt.
Exactly. And the only reason it doesn't just turn into liquid plasma mid-flight is a combination of microscopic cooling channels carved into the blades, and more importantly, the absolute unyielding molecular perfection of the alloy itself.
And that molecular perfection is exactly what we are dissecting today in this deep dive.
It's a fascinating topic.
It really is.
Yeah.
Because people look up at a next generation plane and think, I should invest in Boeing or Airbus.
Oh, the obvious names.
Or they look at a massive air defense system and think, I should buy the prime contractor like Lockheed or Raytheon. But they are looking at the wrong layer of the puzzle.
They're missing the foundation.
Exactly. We're looking at a landscape where the company that controls the specific microscopic recipe for an exotic superalloy is the one truly holding all the cards.
Yeah, the real leverage.
So today we are taking the earnings transcript of ATI Inc. and breaking down a business that has quietly become an absolute choke point for modern civilization.
And, the term choke point gets thrown around pretty loosely in finance. But here, it is the literal definition.
How so?
Well, if you don't have their exact proprietary blend of nickel or hafnium or titanium, your next generation jet engine doesn't just underperform. It fails catastrophically.
Wow.
Yeah. What we are looking at today is a company that has recognized its leverage and is actively reshaping its entire financial architecture to capitalize on it.
This is where we extract the signal from the noise. We are taking ATI's fourth quarter and full year 2025 results and translating the dense Wall Street jargon into plain language.
Because the numbers are definitely telling a story.
Oh, the scoreboard here is flashing bright green and the implications are massive for you, the listener. Let's look at the actual cash coming in the door first.
Always a good place to start.
Right. So for the fourth quarter of 2025, ATI hit $1.2 billion in revenue.
A solid number.
But you and I both know top-line revenue is just a vanity metric if you can't actually keep it.
Exactly. Revenue is nice, but profits pay the bills.
The number that really demands attention is their adjusted EBITDA, which came in at $232 million. They didn't just meet the street's expectations, they blew past the high end of their own guidance.
Yeah, and to understand the sheer gravity of a heavy manufacturing company posting those numbers, you really have to look at the margins.
Let's unpack that.
So in Q4, their adjusted EBITDA margin, which is basically how much operating profit they keep for every dollar sales, hit 19.7%.
That's huge.
It is. That is a massive 180 basis points increase from the fourth quarter of 2024.
Let's hold on that 19.7% for a second, because for anyone used to looking at, say, software companies with 80% margins, 19.7% might sound cute.
Right. It's a different world.
But ATI isn't writing code. They are running massive, energy-intensive industrial facilities. They are melting exotic metals at thousands of degrees.
With huge labor and energy costs.
Exactly. In the world of heavy materials and metal bashing, a 19.7% margin is staggering. It means for every dollar of highly complex metal they ship out, they are keeping roughly 20 cents as pure operating profit.
And the software comparison is actually the perfect lens for this, honestly. Software companies have high margins because the cost of producing a second copy of a software program is zero.
You just copy and paste.
Right. Heavy industry doesn't work that way. Every new pound of metal requires more raw materials, more energy, more labor.
It scales linearly, mostly.
Historically, yes. Metal suppliers lived and died by brutal commodity cycles. They had terrible margins.
So how are they doing this?
What ATI is proving with this 180 basis point jump, which just to be clear is a 1.8% improvement in profitability in a single year, is that they have managed to engineer something close to software-like operating leverage in the physical world.
Wow. I always think of margin expansion in a business like this as a fitness regimen.
Okay, I like that. How do you mean?
Well, revenue is the calories you're taking in, but margin is your metabolism.
Oh, that makes total sense.
Right. ATI isn't just eating more calories by growing their revenue 5% year over year. They're actually metabolizing those calories far more efficiently.
They're building muscle, not fat.
Exactly. They are turning more of that top-line revenue into bottom-line muscle. Revenue grew by 5% to $4.6 billion, but that EBITDA metric grew by 18% to exceed $859 million.
And that delta, that gap between a 5% revenue growth and an 18% profit growth, that is the holy grail for an investor.
It really shows the underlying strength.
Yeah, it means the core machinery of the business is fundamentally more efficient than it was 12 months ago. They are shifting away from selling generic bulk metal and leaning heavily into highly differentiated proprietary alloys where they can just dictate the price.
And that operational muscle flexes hardest when we look at the cash. Adjusted earnings per share, or EPS, was $3.24 for the year, which is up 32%.
A great jump.
But, EPS can be manipulated by accountants. Free cash flow cannot. Cash is reality.
Cash never lies.
For the full year, adjusted free cash flow was $380 million, up 53% year over year.
Wow.
If a company generates $380 million in pure unencumbered cash, they have options. They could pay down debt, they could buy a competitor, they could build a new facility. What did ATI do?
They bought their own stock. Aggressively.
Like how aggressively?
ATI returned $470 million to shareholders over the year via share repurchases.
Wait, $470 million?
Yeah. If you were doing the math, yes, that represents 124% of their free cash flow.
That's incredible.
And since 2022, they have repurchased about $1 billion of their own shares at an average price of $51 per share.
Wait, if they only generated $380 million in cash this year, but they spent $470 million buying back stock, they are dipping into their reserves.
They are.
They're essentially saying, we have no better use for our cash right now than betting on ourselves.
It is a profound statement of confidence for management. I mean, when a company buys back its stock at that velocity, it usually means the executive team looks at their internal projections.
The stuff the public can't see yet.
Exactly. The contracts they haven't announced yet, the technological leads they have over competitors, and they believe the public market is fundamentally mispricing the stock.
So they are buying it up while it's cheap.
They are eating up the available shares before the broader market wakes up to the reality of their backlog.
Man, if a management team is that supremely confident, it forces you to ask, what exactly are they pulling out of the ground or cooking in their labs that people are so desperate to buy?
That's the billion-dollar question.
This brings us to the undisputed engine of this company, which is the aerospace and defense segment.
It's massive for them.
In 2025, A&D made up 68% of their full-year revenue, up from 62%. Jet engine sales alone grew by 21%.
Strong numbers across the board.
But the defense side, that is where the numbers stop making sense and start looking parabolic.
Yeah, the defense sector is experiencing a complete structural paradigm shift. Overall, defense revenue for ATI grew 14%.
Which is good.
Right, but within that umbrella, the missile segment skyrocketed. Missile revenue was up 127% year over year.
Wait, 127% growth in a physical manufacturing segment is nearly unheard of?
It's staggering.
They specifically called out demand for alloys like C103 and titanium 64 across multiple programs, notably the PASI-3 and DIATIS systems.
Right, the really advanced interceptors.
But let's pause here, because this is where the financial analysts usually gloss over the science. I hear C103 and I think of like a tax form.
Yeah, it doesn't sound very exciting.
What actually is this material, and why is the Defense Department suddenly buying it in such massive quantities?
Well, C103 is just a brilliant piece of metallurgy. It is a niobium-based alloy.
Niobium, got it.
And niobium is a refractory metal, meaning it has an extraordinarily high resistance to heat and wear. To create C103, you take niobium and alloy it with about 10% hafnium and 1% titanium.
Okay, so you mix those three together.
Right. And the result is a material that maintains incredible structural integrity at temperatures that would literally liquefy steel.
So we are talking about the nozzle of a rocket, the part where the actual fire comes out.
Precisely. If you look at a system like THAAD, the Terminal High Altitude Area Defense System, its interceptors fly at hypersonic speeds to destroy ballistic missiles outside or just inside the Earth's atmosphere.
Which means a ton of friction.
A massive amount. The friction of the atmosphere at those speeds, combined with the heat of the solid rocket propulsion itself, creates an environment so hostile that almost every element on the periodic table fails.
But C-103 survives.
C-103 survives.
And ATI is one of the only companies making this.
They are one of the very few entities on the entire planet with the technical capability and the cleared supply chains to produce aerospace-grade C-103 at scale.
Wow. So they really cornered the market.
Yeah. When the geopolitical situation dictates that the U.S. and its allies need to rapidly replenish their stockpiles of PAC-3 Patriot interceptors and SAN systems, the defense primes like Lockheed Martin can't just source this metal from a random foundry.
They can't just go on Amazon.
Exactly. They have to go to ATI. That bottleneck is what drives a 127% revenue spike in a single year.
It's the ultimate reality check on global defense, honestly. You can authorize $1 trillion defense budget in Congress, but you cannot legislate physical matter into existence.
That is so true.
If you don't have the hafnium and the niobium precisely alloyed, your interceptor missile doesn't get built.
And the barriers to entry here are just insurmountable for new players.
Yeah.
It's not just having the raw materials, it's the qualification process.
Like getting certified to sell to the military.
Right. To get an alloy certified for a defense or commercial aerospace application takes years, sometimes a full decade of rigorous testing.
A decade. Just to approve the metal.
Yes, because every single microscopic defect could result in a catastrophic failure.
Speaking of commercial aerospace, the moat they've built there is just as wild. On the earnings call, they mentioned that ATI now produces 6 of the 7 most advanced jet engine nickel alloys in the world.
6 out of 7. It's incredible.
And the only one they don't produce is made exclusively by the original equipment manufacturer themselves. How does a single supplier corner the market on commercial jet propulsion that thoroughly?
By focusing relentlessly on what they call content per engine, as airlines transition their fleets from legacy engines to next-generation engines.
The ones that are more fuel efficient.
Exactly, which also means they run much hotter. They require way more of these exotic alloys. So even if the total number of planes being built stays flat, ATI captures more revenue for every single engine that rolls off the assembly line.
They gave a very specific example of this that we need to translate. The isothermal forging deliveries to Pratt & Whitney.
Right, that was a key point.
They noted that ATI's content on those specific deliveries has grown 6 times 6x from 2023 to 2025. First off, what is isothermal forging, and why is it multiplying their revenue?
Isothermal forging is a fascinating process. Iso means same, and thermal means temperature.
Okay, simple enough.
Normally, when you forge metal, you heat a piece of metal up until it's malleable, and then you smash it with a heavy press.
Like a blacksmith hitting a hot horseshoe.
Exactly. The problem with these advanced nickel superalloys is that they are incredibly sensitive to temperature changes. If the metal cools down even slightly while it's being pressed by the die, it will crack or shatter.
Because the molecular bonds are so rigid.
Precisely. So in isothermal forging, the massive hydraulic press dies, the tools actually squeezing the metal, are heated to the exact same blistering temperature as the metal itself.
Wait, the tools themselves are heated up?
Yes, usually around 2,000 degrees Fahrenheit. The dies are often made of exotic materials like molybdenum just to survive the process.
That sounds intense.
It is. The metal is then squeezed incredibly slowly, sometimes taking several minutes for a single press, in a vacuum or inert gas environment to prevent oxidation.
So they are essentially keeping the metal in a perfectly stable, intensely hot environment while they slowly mold it into the shape of a jet engine disc. That sounds ridiculously expensive and slow.
It is both of those things, but it is the only way to produce the rotating parts for Pratt & Whitney's geared turbofan, or GTF, engine.
The GTF engine.
Yeah, and this ties into a massive story in the aviation world right now. Pratt & Whitney has had widely publicized issues with the durability of the GTF engines.
Oh, right. Forcing airlines to pull planes out of the sky.
Exactly, for accelerated shop visits and maintenance.
Wait, so the engines are wearing out faster than expected and they're being brought into the shop. Why is that good for ATI?
Because of MRO maintenance, repair, and overhaul. The high-stress, hot section parts of the engine, the parts made of API's isothermal forgings, have to be replaced or refurbished during these shop visits.
Oh, I see.
ATI makes money when a new plane rolls off the line, but they make a massive amount of high-margin recurring revenue when those engines come in for repair.
So that 6x growth in Pratt & Whitney content isn't just new builds.
Right, it's the massive wave of accelerated maintenance.
That is a brutally effective business model. They win if the new planes fly, and they win if the engines need premature overhauls.
It creates a tremendous revenue floor. Roughly 50% of their jet engine mix is MRO.
Half their revenue is just repairs.
Yeah. In an industry notoriously vulnerable to cyclical downturns or manufacturing delays, I mean, look at Boeing's ongoing struggles. Having half your revenue tied simply to keeping the existing global fleet safely in the air is a massive structural advantage.
Okay, so the sky and the stratosphere are thoroughly dominated. But there is a third pillar emerging here that seems disconnected at first glance.
The energy side.
Right. They highlighted their specialty energy segment. It was up 9% year over year in the fourth quarter. When I hear energy, I instantly think oil and gas, but that's not what's driving this, is it?
Not at all. The driver here is actually the explosive growth of artificial intelligence.
AI, how does that connect to heavy metals?
It's about data centers. People are realizing that data centers require an astronomical amount of uninterrupted baseload power. Tech companies are seeing that wind and solar cannot provide the 24/7 reliability required to train trillion-parameter AI models.
So they are looking for alternatives.
Exactly. This has sparked a massive renaissance in nuclear energy.
And how exactly does a specialty metal company play into the nuclear renaissance? Are they building the reactors themselves?
No, they are providing the elemental building blocks that make the reactor safe.
Okay, keep going.
In a nuclear reactor, you have fuel rods and control rods. You need materials that can survive incredibly corrosive, high radiation, and high heat environments.
Which sounds exactly like ATI specialty.
Right. But there is a very specific atomic dance happening here. You need some materials that allow neutrons to pass through them freely to sustain the nuclear chain reaction.
Like what?
Zirconium. It is almost entirely transparent to neutrons. It's the perfect material to clad the uranium fuel rods.
Okay, so zirconium lets the reaction happen, but what about when you want to slow the reaction down so the reactor doesn't, melt down?
For that, you use control rods. You need a material that is highly efficient at absorbing neutrons.
And what's the magic metal for that?
Hafnium. Hafnium is incredible at absorbing neutrons. But here's the trick of nature. Zirconium and hafnium are almost always found together in the exact same mineral deposits in the Earth.
Oh, that's inconvenient.
Very. Chemically, they are nearly identical. Separating them is one of the most difficult, complex, refining processes in all of material science.
And let me guess, ATI is one of the masters of separating zirconium from hafnium.
They are indeed.
Yeah.
ATI recently renewed a long-term specialty energy contract that actually expanded their market share by more than 20%.
Wow.
Yeah, establishing them as the majority supplier for that client. As the world scrambles to build small modular reactors and extend the life of existing nuclear plants to power AI data centers, the demand for highly refined zirconium and hafnium is accelerating.
So we have jet engines growing at 21%, missiles growing at 127%, nuclear materials accelerating. It paints a picture of total dominance.
It really does.
But let me step in here and poke some holes. Let's look at what they are leaving behind. Management explicitly noted they are intentionally shrinking their industrial, medical, and electronics businesses. Those segments are trending down in the low to mid single digits.
That is accurate. They are deliberately reducing their footprint in those markets.
Hold on, though. Medical devices and electronics are massive, historically stable industries. Walking away from them to go all in on defense and aerospace feels like an incredible gamble.
I can see why it looks that way.
What if the geopolitical tensions cool down? What if the defense budget gets slashed? Isn't abandoning diversification to go all in on rockets and jet engines a massive vulnerability?
It's a fair critique, and it strikes at the heart of CEO Kim Field's strategy. What she is executing is a ruthless application of the 80-20 rule.
Okay, explain that.
Yes, medical and electronics are stable, but for ATI, they are highly commoditized and lower margin. Competitors in Asia can produce basic medical-grade titanium alloys much cheaper than ATI can in its U.S. facilities.
So it's a race to the bottom on price.
Exactly. Currently, medical and electronics only represent about 3% to 4% of total sales.
Oh, so they aren't abandoning a cash cow. They are amputating a slow-growth appendage.
Precisely. They have recognized that their most precious asset isn't titanium or nickel, it is their manufacturing capacity.
Their physical footprint.
Right. Their hydraulic presses, their melting furnaces, their skilled labor. These are finite resources. Every hour a machine spends pressing a low-margin titanium joint replacement is an hour. It is not pressing a ridiculously high-margin niobium rocket nozzle.
They are essentially firing their least profitable customers to clear the runway for the Pentagon and the aerospace primes.
And to address your concern about the aerospace cycle stalling out, the data in the earnings call provides a staggering counterargument.
What's the data?
Their backlog remains incredibly robust at just under 1 year of revenue. But the real metric to watch is lead times.
How long a customer has to wait to get their order.
Exactly. For these exotic materials, the hafnium, the specialized nickel, the lead times are extending dramatically. Some lead times have doubled, up to 2x since just the previous quarter.
Wait, lead times doubling in 3 months? That means a customer who used to wait 6 months for a shipment is now being told it will take a year.
That's the reality right now.
When demand so vastly outstrips supply that lead times double, that means the supplier holds every ounce of leverage in the negotiation room.
Exactly, which transitions perfectly into how management is utilizing that leverage. Because the guidance they issued for 2026 is where the financial engineering truly shines.
Let's break down that guidance. The headline figure is an absolute psychological milestone. They are guiding to $1 billion of adjusted EBITDA at the midpoint for 2026.
Which is a huge psychological barrier to cross.
A 16% increase year over year. $1 billion in pure operating profit.
And the margins we were discussing earlier, they are tracking to break the 20% mark for the full year.
Breaking 20% in heavy industry, that's wild.
They did specify that the first quarter will be a bit lower in the 18.5% to 19% range.
Here's the dip.
Due to normal planned maintenance in their high-performance materials and components segment. But in the second half of 2026, those margins will push comfortably above 20%.
Flowing down to the bottom line, they are targeting a 2026 adjusted EPS range of $3.99 to $4.27.
Solid growth.
And their free cash flow is targeted at a midpoint of $460 million, which is a 21% jump year over year. All of those numbers sound fantastic.
They really do.
But the piece of the call that made me stop the recording and rewind was when the new CFO, Rob Foster, explained exactly how they are getting to that $1 billion EBITDA.
This is the best part.
He stated that the growth walk from 2025 to 2026 is roughly a 50-50 split. 50% of the growth is coming from increased volume, and 50% is coming purely from pricing.
Think about what that actually means. Half of their profit growth isn't coming from doing more work or shipping more metal.
Right.
It's coming simply because they can charge more for the exact same product.
But how do they secure that kind of pricing power without customers revolting? 50% from pricing.
Through long-term agreements or LTAs, the aerospace and defense industries hate uncertainty.
They need predictability.
Right. They need to know that 3 years from now, they will have the metal to build their planes. So ATI locks them into multi-year contracts.
So they trade certainty for price.
Exactly. As the older, less profitable contracts roll over or hit their built-in escalator clauses in the second half of 2026, ATI resets the baseline. They are finally capturing the value of the scarcity they provide.
But the ultimate proof of their pricing power, and honestly the most shocking revelation in this entire transcript, is hidden in their capital expenditures, their CapEx.
Oh, the co-funding detail?
Yes. Look at the numbers for the new factory equipment. They project gross CapEx of $280 to $300 million for 2026. This is money spent to build out their capacity.
Sounds normal so far.
But their net CapEx, the money actually leaving ATI's bank account, is only $220 to $240 million. Something doesn't add up. They are building a $300 million expansion, but only paying $240 million. Where's that missing $60 million coming from?
The customers are paying for it.
Wait, the customers are writing checks to build ATI's factory?
Yes. Customers are co-funding the expansion to guarantee their own place in line.
That is insane.
They are literally writing checks for roughly $60 million in 2026 to help build ATI's new nickel melt system. When a customer is willing to pay to build your factory just so they have the privilege of buying your product when it's finished, you have absolute unmitigated pricing power.
That is mind-bending. I have never seen a dynamic where the buyer builds the seller's house. What exactly are they building that is so critical?
This investment centers around a new primary melt, vacuum induction melting, or VIM, furnace.
Okay, vacuum induction melting. Let's translate this. Why are customers so desperate for this specific piece of equipment that they are throwing tens of millions of dollars at ATI to build it?
A VIM furnace is essentially a highly controlled, vacuum-sealed environment used to melt and alloy reactive metals. Remember how we said these proprietary aerospace alloys, like the 6 out of 7 advanced nickel alloys, are incredibly complex?
Yeah, the molecular perfection stuff.
Right. You cannot melt them in an open-air foundry.
Because of the air itself.
Exactly. The atmosphere is mostly nitrogen and oxygen. If you melt titanium or advanced nickel alloys in the open air, the metal reacts violently with the oxygen and nitrogen,
Which ruins the metal.
Microscopic impurities form within the molecular lattice of the metal. If you take an alloy with microscopic oxygen impurities and forge it into a turbine disc, and then spin that disc at 20,000 RPM inside a jet engine at Mach 2, those impurities act as stress concentrators.
Oh, wow.
The disc shatters, the engine explodes.
So the Vim furnace pumps all the air out of the chamber, creating a vacuum, and then melts the metal. How do you heat it if there's no air to burn a flame?
Through electromagnetic induction. They wrap copper coils around the crucible and run a massive alternating electrical current through them.
Like an induction stovetop, but massive.
Basically. This creates a rapidly changing magnetic field that penetrates the metal, creating eddy currents inside the metal itself. The electrical resistance of the metal generates the heat, melting it from the inside out.
That is so cool.
And the magnetic field also violently stirs the molten metal, ensuring the alloying elements, the hafnium, the niobium, the titanium, are perfectly and evenly distributed.
That sounds like a sci-fi device, and it must take forever.
It does. On the call, an analyst asked about the melt times for these exotic alloys compared to standard alloys like a generic 718 nickel. ATI's management noted that for these proprietary alloys, the melt times can be 3 to 4 times longer.
3 to 4 times longer just to melt it.
Yes, you are trading speed for absolute, uncompromising purity. The original equipment manufacturers demand this purity, but the global capacity for Vim melting is severely constrained.
So it takes longer to make, it's harder to make, and the customers are so starved for it, they are funding the equipment.
Yep.
Management noted that this new capacity will come online in the second half of 2027, and they are targeting a run rate of about $350 million of incremental nickel revenue by mid-2028. Here is the kicker. That future capacity is already 80% contracted.
That's the best part.
They aren't building a $300 million furnace and hoping people buy the metal. They are building it because the orders are already signed, sealed, and locked in.
It is the ultimate de-risking of capital investment. And this ties into a crucial personnel transition that the market was watching very closely.
The CFO change.
Yeah. This entire strategic pivot shedding, the low-margin business, locking in long-term agreements, and coercing customers into co-funding CapEx was largely architected alongside the retiring CFO, Don Newman.
Newman had a massive impact. Over his 6-year tenure, margins went from 10.7% in 2019 to 19.7% today. He basically doubled the profitability of the company.
He really did.
When the architect of a turnaround steps down, retail investors understandably get nervous. Does the transition to the new CFO, Rob Foster, introduce execution risk? Are they bringing in an outsider with a different philosophy?
Well, if we look at Rob Foster's background, it actually provides significant reassurance.
Yeah.
He isn't an outsider brought in by a search firm to shake things up.
Oh, he's an internal hire.
Foster is an ATI veteran with over a decade at the company. Most recently, he served as the president of their specialty alloys and components business. Before that, he ran operational finance.
So he didn't just crunch the numbers, he actually ran the division making the specialty alloys. He knows the factory floor.
Exactly. Furthermore, he has been closely partnered with CEO Kim Fields since 2019. This is not a disruptive pivot. This is a seamless continuation of the existing playbook.
That makes sense.
They are promoting the operator who was in the trenches, building the strategy to the CFO seat so he can continue executing it.
Which brings us perfectly to the ultimate synthesis. We've gone from the molecular structure of niobium to the financial architecture of customer co-funding. What is the bottom line for the investor?
This is what it all comes down to.
If someone is looking at the ticker symbol right now, what are the actionable takeaways?
The stance we have to take, based purely on the data presented in this earnings call, is highly bullish.
Okay, bullish. Why?
The thesis rests on 3 unshakable pillars. Number 1, unprecedented pricing power. ATI is projecting consolidated incremental margins to average 40% for the full year 2026 and to push above 40% in the second half.
Let's define incremental margin quickly. That means for every new additional dollar of revenue they generate above their baseline, 40 cents is dropping straight to the bottom line.
Yes. Because their fixed costs are already covered, the new volume, especially the volume produced in the co-funded facilities, is incredibly profitable. That kind of leverage is just incredibly rare in heavy physical manufacturing.
Wow. Pillar number 2.
Exceptionally high switching costs. In the software world, switching costs mean you have to train your employees on a new database.
Which is annoying, but doable.
Right. In the aerospace world, switching costs mean grounding fleets. Customers cannot simply take their business to a cheaper competitor.
Because it takes a decade to certify a new supplier.
Exactly. Whether it's hafnium for an AI nuclear power infrastructure or a proprietary nickel alloy for a jet engine turbine disc, the qualification processes take years. In many of these specific use cases, ATI is not just the best supplier, they are the only viable certified supplier.
And Pillar 3.
De-risked growth.
Those multi-year long-term agreements insulate ATI from the chaotic short-term noise of the broader market.
So they don't sweat the daily news. Right. They do not have to worry about a sudden dip in spot market commodity prices because their customers have already guaranteed the volume and the price. The backlog is full, the lead times are extending, and the future capacity is 80% sold out before the furnace is even built.
If I can try to encapsulate this, in the financial world, we always hear about the pick and shovel play during a gold rush.
The classic analogy.
The idea is that instead of betting on which prospector will find gold, you sell shovels to all of them. But ATI isn't selling shovels. Shovels are commoditized. Anyone can make a shovel.
That's right. The pick and shovel metaphor fails here because it implies low barriers to entry.
Exactly. I look at ATI like the company that somehow bought the only toll bridge leading out of the gold mine, and they made the bridge out of a proprietary alloy that nobody else knows how to replicate.
That is a perfect way to look at it.
It doesn't matter if Boeing wins the commercial aviation war or if Airbus wins. It doesn't matter if Lockheed Martin gets the missile contract or Raytheon gets it. They all have to cross the bridge.
Yep, every single one of them.
They all need the exact, irreplaceable metals that only ATI can supply in order to build their engines and their missiles.
That is the true power of owning the choke point. You stop trying to predict the winner of the race, and you just own the track.
We've covered a massive amount of ground today. The core takeaways from this earnings call are undeniable. A confident march toward a $1 billion 2026 EBITDA target, an operating margin pushing past 20%, and a customer base so desperate for the product, they are literally writing checks to build ATI's infrastructure.
But as we wrap up, I want to leave everyone with a broader, perhaps slightly provocative thought to mull over.
Let's hear it.
We discussed how ATI is actively, purposefully shrinking its business in medical and electronics. They are walking away from stable revenue to focus entirely on defense, next-generation aerospace, and AI energy infrastructure.
They are burning the boats.
They are. They have aligned their entire physical manufacturing base, their capital expenditures, and their scientific research to perfectly mirror the geopolitical and technological bottlenecks of the 2020s.
It's a very specific focus.
It is. The question an investor has to ask themselves is this. By concentrating so heavily on these specific friction points, has ATI built an unassailable future-proof moat? Or have they made a hyper-concentrated, irreversible bet on the volatile state of the world remaining exactly as chaotic as it is today?
If peace breaks out, does the toll bridge lose its traffic? It is the ultimate billion-dollar question for anyone looking at this stock.
It really is.
This has been a massive journey from the vacuum chambers to the balance sheets. Keep digging into those SEC filings, look past the shiny finished products on the runway, and remember, sometimes the most valuable piece of a billion-dollar machine isn't the software and it isn't the brand name. It's the invisible, perfectly melted alloy keeping the whole thing from tearing itself apart. That officially closes today's deep dive.